A message from our sponsor. Need a current or retrospective SMSF property valuation? Whether it's for annual financial statements, pension commencement or related party transactions, SMSF Property Valuations offers fast, reliable and audit-ready reports across Australia. As an accountant or SMSF trustee, do you need a valuation that satisfies ATO rules, includes documented methodology and ticks all audit boxes? SMSF Property Valuations delivers an easy online ordering process to finish the job quickly. Hello and welcome everybody to another episode of the Cross Country Super Podcasts. And as usual, I'm joined by Jemma Sanderson way over in Perth. How are you,
Hi,
Jemma?
Darin. I'm good. It's all, at the time we're recording this in the lead up to 30 June, so it's all a bit hectic, but yeah, all good.
So it's great to see you on the Zoom as usual. And look, I think you would have been hiding under a rock since the election, not to know that Division 296 tax has been absolutely dominating discussions, not only within the sector, but I think it's dominating news cycles as well. I see heaps of coverage on the mainstream media now about this impost. My question always is, why the hell weren't you talking about it before the 3rd of May? But
100%. Yeah.
it could be too late now. But so today, our discussion will be designed around not whether or not it will come in, because I think it is a fait accompli, but more around as it comes back onto people's radars, there are a lot of misunderstandings, a lot of preconceived ideas, and a lot of misconceptions as to actually how this tax will work. And I don't think any of the arguments that the politicians are making right now as to, I think in their heads, allaying our fears as to how it would work, are having any sort of cut through, because basically I actually don't think they understand what the mechanics of it is themselves.
Are you surprised
Because
by that though, Darin? Are you really
no, I'm
surprised?
not. I'm not surprised at all, Gemma, about that, but it is a pretty bad starting point, isn't it? When the people who are bringing it in can't even can't even explain the concept properly or justify a case for what they're doing, when some of the more egregious elements included in the bill are being challenged or being
Yep.
questioned,
Yep.
which is pretty disappointing, but as you say, not unexpected.
No, not
So,
unexpected.
so do you want to start with just a bit of a background or what they're saying before we go into the myths or myth busting, or do you want to get into the
Yes.
myth busting?
Well, I think in conveying what it's looking like, there'll be some myth busting along the way. So we'll just mash them all in together as we're pretty good at doing. No doubt we'll go off piste a few times, but anyway, we'll get there. So this is the $3 million tax, which a lot of people are talking about, like you said, Division 296. So it's designed, and this came out just after the SMSF Association conference in February 2023. We had draft legislation released in October 24, and it went through the House of Reps and sort of sat in the Senate and stalled. And then when the election was called, it just sort of fell on the floor. Now, I was hoping, as I'm sure the industry was, that it would stay on the floor and it would just get swept out and it wouldn't come through. However, with the election result, sneeze,
Bless you.
with the election result, it's now, like you said, on the table in front of a lot of people. Everyone's going, oh, this thing might come through now. And so there's a lot of criticism. Well, it's hitting the mainstream media. So what is it looking like? So there's sort of three big elements to how this will be calculated. The first thing is looking at your opening total super balance, and that's all of your super accounts in Australia. Your closing total super balance, what's that difference as a starting point? And that's our sort of baseline. And I refer to it as like raw Division 296 earnings or raw earnings. So that's our first bit. Then we've got to add back withdrawals, take off net contributions, and that gives us our then earnings number. So then from that perspective, we have to determine, well, how much of that earnings number is going to be subject to tax. So the way that's calculated is you look at your closing balance less 3 million. So the extent to which you're over the 3 million. So say you end at 4 million, you're $1 million over the balance. So you're a quarter of your balance is in excess of $3 million. So then whatever that earnings figure is, let's call it $500,000, a quarter of $500,000 is going to be taxed at 15%. So it's to dispel one of the myths immediately, which is I'm paying 15% tax. It will never, ever, ever be 15% tax. Even the chap that has $1.5 billion apparently in his super, just with one investment, his effective tax rate on his earnings number is 14.97%. So we're getting there, close, but even that guy's not paying 15%. So I can't see that because it's the extent to which you're over 3 million, that is the proportion of 15% that applies. It's never, ever going to be 15%. So that's really how it's going to work. Now, the concerns that a lot of people have is that if they do take a withdrawal out, that the withdrawal gets added back to their closing total super balance and then the extent to which they're over. That's not going to be the case. And then again, we'll get to all the myths and how those work. The other thing that I just wanted to also be clear on is that this is an individual tax. So the individual will get a notice of assessment from the tax commissioner saying, Dear Jemma, your Div 296 tax is this, and then you pay it. So I have the obligation to pay that. I can then ask my fund to release it, to pay it, but I can just pay it from my own resources. So to be clear that this is a different bucket, so I'm going to use my hands here, which I appreciate the people who are listening in aren't seeing the video, but so we've got a bucket that's the individual bucket. The super fund bucket is not changing. The way that that operates is not changing at all whatsoever. So you're paying 15% tax on income. And if you've held an asset for longer than 12 months and you sell it, so you've got a realized capital gain, then you'll get a 1/3 discount. So that position isn't changing. And then, of course, if you're in retirement pension phase, whatever your retirement pension phase amount is as a proportion of the whole fund, you're getting a 0% tax rate on those, I'll call them realized returns, being realized capital gains and realized income along the way. So that position isn't changing. It's just that that is then guiding, or is they're the line items going into the calculation for the individual. So the other thing with that is that closing total super balance on the super fund side, if you do sell something or if you do receive that income, that closing balance will reflect any tax payable over the course of the relevant year as well. So just to be aware of how that all factors in. So very high level, we've got two different buckets here. They will interact a little bit in that the super fund bucket, which isn't changing in terms of how it's taxed, that will then guide what might be taxed in the individual bucket.
Yeah, just in that just in that opening information, there's already so much to unpack there. I think one of the important things, and this isn't what we discussed before we came on air today, but one of the questions I had, and I think a lot of people out there had, is how it works from the point of view of what you just said about it's levied at the individual, but they can have it paid by the super fund if they want. So one of the questions that came up recently on our professionals day was, okay, so I'm slugged for the new tax. So I pay it on my unrealized capital gains. What happens when I sell the asset and assume that I'm not necessarily in pension phase? What happens
Yep,
if I sell the asset? Do I still have to pay capital gains tax on the sale of that on the event? And the answer is yeah, you do
you
because
do. Yeah,
because
because you've
there's
got the
no
two buckets.
that's right. There's no
Yeah,
transfer of credit, and you don't get a tax credit for the Division 296 tax that you've potentially already paid, which is I know we didn't discuss this, but that's almost like a double whammy, isn't it? Even if you get discounts like you mentioned, I'm sure a lot of people aren't going to be happy with being slugged once for the unrealized gain and then getting absolutely no benefit or recognition that they've already paid tax effectively on that gain. It's just that when it's realized, oh, we'll slug you again.
We'll slug you again. Yeah, exactly. And that's exactly that whole thing of my two buckets is that again the super fund bucket won't change. And there's some other considerations there. Some people have said, oh well, all my unrealized gains will be caught, but it's unrealized gains like year on year. It's not unrealized gains since the fund acquired the asset. So we're not resetting cost bases or anything like that, unlike what we did with the transfer balance cap. It's value, and our starting point is going to be, it's looking like 1 July 2025 is that first valuation that we're looking at. But that's a really, really good point on, and a lot of people that, I mean, it's confusing, right? So,
Yeah,
the super
100%.
fund bucket continues on. So you've paid tax on your personal bucket along the way, but you get no credit for that against the tax when you ultimately sell the asset. Now there's a couple of reasons for that. One is because they're two different entities. But the other thing is if you've paid tax along the way, the 296 tax along the way, that's on the total difference between the opening and closing balance with the adjustments. So the attribution of some of that tax to a particular asset when it's sold in the fund, can you imagine the record keeping requirements on that and the justification for that? Because if you sold an asset in here and you made $1 million gain, and so the tax, if it was all accumulation, so the tax on that would be $100,000. But along the way, say you've paid Div 296 tax over 5 years of 150 grand, then you would be like, oh, well, I'll just offset that. It's like, well, how do you attribute and where's the integrity of those numbers to say, okay, well, of that 250 grand you've paid, or whatever the number was I said, that you've paid along the way, how much of that relates to that particular asset? Ooh, I wouldn't want to be the person that's auditing that. That's for sure. So it just can't work. It just
But
practically can't work.
but Gemma, I thought that we were doing this methodology to make it easier to administer.
Oh well, it's
Isn't
and
that the argument?
well, it is because it is easier to go opening closing with some adjustments, but then that's on the basis that they are two separate buckets that we're looking at. And I mean, this is better targeted superannuation concessions, is the like that's the legislation, what it's called.
Description. Yeah.
Yeah. So they're saying, well, do I be as flippant as this and say, yeah, you've paid tax along the way. We don't care. You've still got to pay tax over here. And this is again, we'll go off piste all the time. The When questioned about this, the politicians and the whole, it's unfair because it's capturing unrealized gains, and that is probably one of the biggest criticisms of it, capturing unrealized gains. And there's nothing else in our tax system that does that. Then when the politicians come out and say, well, because when we consulted widely, which I take offence to, because that's the biggest load of twaddle that I've ever heard. And when we consulted widely, no one could come up with an alternative. Then I also take offence to that, as does everyone else in the industry, because this absorbed so many of us with that like submissions and things like that. The consultation itself was absolutely tiny, but the submissions made as part of that and subsequently ongoing, just in terms of how this was going to work. I just it really dismisses and is borderline disrespectful for the industry who has been advocating alternative methods and against this tax since the get-go.
Yeah, I
So I
couldn't
got off
agree.
my high horse then.
No, I couldn't agree. I couldn't agree more with that. And it's an outright lie. I'll call it an outright lie to say that the consultative process was, prudent
Extensive.
and extensive. That is an outright lie.
Yeah.
I don't know how other I can't describe it any other way. Plus, um, look, it's patently obvious that you're not going to change it because you want to generate a particular level of revenue, and
Revenue. Yep.
if you change the methodology, that's going to destroy what you do. However, there are going to be consequences down the track,
Consequences. Yep.
which I don't think that you're going to get that revenue anyway. But I'll go even further off piste, Gemma.
Oh,
Just
okay. Yep.
just on this, it just amazes me when elected officials can go out and hold a media conference and make it so blatantly obvious that they don't actually understand how what they're implementing works. So it's a great point to make that this tax is levied on an individual level. How you
Yep.
pay it, there's an option as to how you satisfy that liability, but it
Yep.
is leveled on an individual basis. So it disappointed me, but it didn't surprise me when I saw the treasurer get up in front of journalists. Was it last week, maybe? And he was asked about whether or not this would apply to the Prime Minister. And he's brought into the fold. There's going to be a deferral mechanism for the Prime Minister. He's not going to have to pay it. Like he might get caught, but he's not going to have to pay the liability like we are immediately. Why? Oh, but that because he hasn't got his hands on his suit.
Because of the
He wouldn't
defined
have
benefit.
accessed. He
Yep.
wouldn't have accessed his super yet. So it's not really fair to ask him to pay a liability when he hasn't actually got the money. Well, my response to that would be, so you don't understand that it is a tax based or levied at the individual because what's to stop him from paying it himself?
Yeah, that's the thing. He can just pay it
He's got
himself. That's
money
exactly
himself,
right.
doesn't he?
Yeah.
There's no allowance for any of us to say that,
So the defined benefit ones they'll get to run a debt account if that's what they want
yeah,
to do and defer it.
yeah,
But that does get whacked with interest. So I'm not like I don't want to be supportive of these things. But again, there's the misinformation out there about it. And I mean, blind Freddie could tell you that you're going to be asked that question. And so that I think that he should have been briefed more appropriately. Anyway, this isn't a political podcast for us to talk about, but
I
it's
just no. But if
certainly
you're gonna no, but if you're going to spruik the wares of what this measure is going to be, at least understand what the workings of it are. And that
yeah,
is, I'm sorry, that being levied at an individual on an individual basis is one of the fundamental things. I mean, that,
yeah,
yeah, I know you didn't talk about this, but that goes to another myth about, you know, how the $3 million threshold applies, as in does it apply on a whole fund basis, or is it an individual? No, it's on individuals' total super.
individuals. Yeah,
It's not got anything to do with the cumulative balance of the fund. It's actually, so it could be one member has 5 million, one member has 1 million. The 1 million person doesn't have to pay Div 296. The person with 5 million, they're going to get caught out by this.
yeah.
So, not knowing how those machinations work is just, to me, it just, that makes my blood boil. At least get your story right. If you're going to
Or
prosecute a
understand
person
it.
with
Yeah,
this, yeah, to have a understanding so that when you're challenged, you can at least give me a sensible, intelligent answer about it. And I may not agree with what you're saying, but at least I can say that, yeah, okay, well, you've made your point pretty well there. So
yeah.
I've got to
And
conclude.
then back to your example that you just gave of, you've got a fund worth $6 million. And so this is a lot of couples, we've got a $6 million fund. It's equal. So it's not.
Yeah,
Like sometimes it is reasonably equal, but a lot of times it's not. But they just view it as it's their joint super fund, which is
yeah,
not incorrect. But the application of these rules is going to bite those people because
yeah,
someone's got five and someone's got one. And so that leads into some strategies to consider, is there an opportunity to pull down some of this to swing this way? Obviously dependent on contribution limits and things like that.
yeah,
But, but the whole fund is worth six. But again, that's a bit irrelevant. It's what are the individual balances in there? And that person that's got one, they could have $3.5 million sitting elsewhere. They could be a defined benefit member getting something else. So again, it's across the board. And this is where, even though, I mean, I don't like the way the formula is working because it captures unrealized gains and things like that, and there are alternatives. It's the whole opening to closing with some adjustments in between does make it administratively easier for the administrators, being the tax office, who are going to be the ones sending these out, because they already capture a lot of this information. However, when you look at it more widely, like most people, who is it impacting? Well, they're mostly SMSF members, so obviously very, very relevant to our industry. And so that's really what the important factor is that we're looking at there. So, they said 80,000. I think the Grattan Institute's done a whole bunch of other numbers to say that in a few years' time it'll be far wider, which brings me to the other big criticism of this, is that it's it's unindexed. And so so to start with, it might not bite too much, because say, like the example I gave at the start, which was your closing total super balance is at 4 million, you're paying 25%. So your extent to which you're over 3 million is 25%. So your effective sort of Div 296 tax rate on any Div 296 earnings is going to be 3.75%, a quarter of 15% effectively. So you might think, oh, well, that's bloody bugger all in the scheme of it all. At my super fund level, I might be in pension phase, so I'm not paying any tax at the super fund level, and maybe there's some accumulation in there. Everyone's going to be different, and then I've got a 3.75% tax on my Div 296 earnings. So overall, it might not necessarily be a bad outcome. But if your balance continues to go up with unrealized gains, realized gains, income, and you're not pulling out as much, and that 3 million just stays where it is and doesn't go up, then that proportion is really going to start to bite. And that's where we're definitely, seeing some of these tax positions coming through. And so that will be a consideration.
Yeah, and getting back to what you said right at the start, Jemma, and I'm getting back onto the black run now.
Okay, right.
I'm off piece, that I'm back on the track. It is really important from a myth busting perspective to understand or to delineate between the actual application of the threshold, and then, if you've met the threshold, how the calculation of the tax works. I
Yeah,
know that there's a lot of concern out there with this add back provision in the calculation,
yeah,
thinking that if they get to 30th of June 2026, if they make withdrawals to get their total super balance under 3 million bucks, it'll be added back, so it won't make any difference. But basically, if you've got it under 3 million, you won't qualify for the tax. So it doesn't matter.
yeah. You're out. You're
It doesn't
totally out.
matter. It doesn't
Yeah,
matter beyond that, whether or not you make withdrawals or whatever, for it to be added back. The fact of the matter is, you haven't actually qualified. If you make a withdrawal and you get it under 3 million
3 million.
bucks before
Then
that
great.
point in time, you're clear. But a
Yeah,
lot of people think that, oh, why would I bother to do that, Jimmy? Because it's just going to be added back, and I'll pass the $3 million anyway. But they're getting confused
yeah.
of the two absolutely separate elements of this. Number one, satisfying the threshold, and then number two, actually calculating the
Calculating.
liability and how those elements either come out and go in. But there's quite a lot of confusion around that. I know that there's a lot of questions. Again, on our professionals day, there were a lot of questions around that. And of course, then people look to strategize, and they're already thinking of strategizing it, and we'll get to that obviously later. But
Yep.
that is one area where it's like, no, you've
That's not how
actually
it's going to work. Yep.
understood how this actually, comes into play. But it's a relevant one, because the worst thing would be for people to think that, well, Gemma, why am I even talking about this? Because it's not going to make any difference. I just throw my hands up in the air, because even if I withdraw, $1 million to get me under the 3 million, it's just going to be added back, and I'm going to be caught by it anyway, which is wrong. I wouldn't
Yeah.
want people
Yeah.
to just believe that and then just give up on Well, there's
on
nothing like
on on
yeah.
the on what might be an option
Yeah.
for them. So
Yeah.
that is like the big one of the big questions I have been asked on multiple occasions is, but it gets added back to my TSB, closing TSB. It's like no, like you said. So the first door you've got to open, we've got to get the key for is am I over 3 million at the close of the relevant financial year? And if you're not, then you don't get the keys. So you're not even allowed in the club, a reverse club you want to be involved in. So that's absolutely like the first thing to have a look at. The other thing is that even if you're below 3 million, you might actually still care about this tax if some of that can be attributed to a fall in value without ignoring withdrawals and things, because you might want to carry that forward to a future year in order to offset that against. So if you end up having a Div 296 loss, you can carry that forward to a future financial year. And to offset future Div 296 earnings. So again, that's a small concession that is available if things go back in value. Your example that you use then of, oh, well, I'll pull $1 million out to fall under 3 million. And this is a bit of an it depends. I'm averse to people doing that, most like by and large, only because super is still going to be the best structure to hold assets. So we often get, I'll just pull money out into my own name and invest outside. Now, there's certain profiles of assets where that might absolutely be worthwhile. But again, mostly you're not going to get the benefits of doing that because ultimately, when you sell that asset, if it's in the super fund bucket, you're still getting those concessional tax rates. Yes, you're going to have the personal bucket where you might be paying some tax along the way on the unrealized capital gains, but everyone runs all these numbers. We've run the numbers, and on a lot of scenarios, you're still better off keeping the money in super, even where the threshold is not indexed. You're still better off from that perspective. Again, that's going to depend on the asset and what the intention is with that asset. So if it's a long-term hold for succession purposes, then maybe you don't hold it in the super fund, it goes into an alternative entity. But there certainly are many arguments for just keeping business as usual where it is, because you're still going to get that concessional tax rate on that realized gain at the end of it. So yeah, that certainly is a consideration.
Yeah, absolutely, absolutely, Gemma. And of course, you can't even do that unless you've met preservation age. So,
Hmm, that's right.
people who haven't done that are obviously limited in what they can do and how they go about managing this situation. But I can tell you, and you've probably seen it yourself, I've only heard it from anecdotal evidence that people are already ripping money out of their
Oh,
super fund.
totally. I had
And
one yesterday.
they've,
Yep.
and they've been spooked by it because of this
Spooked.
whole unrealized capital gains notion. And this is coming from Wilson Asset Management founder Jeff Wilson, is saying that he's already seen his clients ripping money out of super and investing it into the family home simply because
Yes.
that
Yep.
is a CGT-free asset for the time being, my
Yep.
cynical hat would say, but he's already seeing it. So yes, that, absolutely. Obviously, we would encourage you to look at it in a rational sense, and of course, you have to make a rational decision. As in, even though you might get slugged for it, you still might be better off leaving your money in super. But so much emotion has come around what they're taxing my unrealized capital gains. It's triggering
A lot
actions.
of people.
You
Yep.
know what? Stuff it. And this is, you know, I'm sure the government and the treasurer, I know the government and the treasurer has been warned numerous times, and not just this government. We're talking about this measure right now, but every government has been warned numerous times. Look, stop making so many changes to
To
superannuation.
super. Yeah.
All it is doing,
Stop tinkering. Leave
because
it
all it is,
alone.
yeah, because all it is doing is destroying people's confidence in the system. And
Yep.
this is a classic case in point, from what Jeff Wilson was saying. If people are ripping money out, it's because they've lost faith. Because it's
Yep.
like, oh, well, if that's going to happen, then my best bet is to put it into my family home because at least I won't get
Pay
CGT on it.
tax on that. Yeah.
Now
So there's
that's
a
not,
couple
it's
of
a, yeah,
consequences of this is so firstly, if particularly if they're invested in a growth asset, then in redeeming that asset and moving it and investing it in the family home or going on a nice holiday or something, they that would crystallize a capital gain in the fund that they may have to
yeah,
pay tax on. And a lot of the
yes,
people that we're talking about in this $3 million realm, often they've got a pension account, they've used their transfer balance cap, and then the balance above is all in accumulation. So if you've got a $5 million total super balance, you might have 2 million in pension and 3 million in accumulation. Now, some people might have that whole 5 million in pension, depending on, like, again, it depends. So if they did sell that asset down to put it into the family home or the like, then they wouldn't be paying tax on that. But um, there's a couple of elements with Jeff's comments. One being it's a bit self-serving because obviously people are pulling money out of the, the assets under advice, but also that's a consideration more widely. Are people going to be, is there going to be not a run on the investments, but are we talking about people are going to stop potentially investing in some of these assets? They won't put money into something that could be a unicorn, or they won't be speculative about their investments using their super fund money, because often that is that capital base that a lot of people have got to invest in things, because if it's actually ends up going bazinga, they don't want to be paying tax along the way on an illiquid asset. And so one of Allegra Spenders, when she her speech about this to the House of Reps back in the day, was it's going to stifle innovation. And I think that that's not a poor argument to consider, because people will be thinking, well, where am I going to get this capital from to innovate with respect to a product, or get those seed investors, et cetera, et cetera. Because the super system, there's $1 trillion in SMSFs. So are people in that system going to be like, oh, well, I could put money towards it, but if it goes up in value, if I put 100 grand in, it goes up to $1 million. If I've got that in another entity, then I'm not paying tax on anything until I sell it. But if I've got it in my super fund, I'm going to be paying tax along the way until I sell it. So back to that profile of the investment, but will it stop people from taking that chance and using their super capital for those sorts of investments?
yeah. Look, many people have already raised that issue that a lot of the seed capital, especially for startup businesses, is coming from self-managed super funds,
Yep.
and it makes sense because um, you know even if you like property or direct shares, it's still a limited universe, right? So
Mm.
you're going to have to look for alternative spaces in which to park your money because it can't just be in those areas because you're not really differentiating what you're doing. So they are looking for this, and of course there's incentives to do it as well. But yeah, it's a good point. It has been raised. I know it's been
Yep.
raised by Peter Burgess at the SMSF Association. But again, the government's ears are painted on as far as this issue goes because, nothing's making a dent. And you and I know how this works. If it's implemented and that is the result that actually comes to fruition, then everybody will scratch their head and start to ask, well, how did that happen?
Yeah.
You
Yeah.
know? So yeah, I mean there are
The other thing with that seed capital and some of these speculative mining stocks, I'm in WA, so there's lots of speculative mining sort of things going on. You need those people that are willing to take the risk, because 1 in 10 or 1 in 20 does end up being the amazing one, and or even might, you've got those golden people that can just pick them all. Anyway, this is where some of these balances are extraordinary. Now, we're not going to get those extraordinary balances going forward because it's so difficult to contribute to super now. And so a lot of people are above the 3 million because and this is, I think 80% of the 80,000 people, if not more, are in retirement phase. So we're going to see the exit of a lot of this money out of super in the next couple of decades, where the groundwork for that was laid in 2007 when those changes came through. So we're going to see that anyway. We're just not going to have necessarily some of these huge balances that we're seeing now, which I feel like that's where the target has been. Is it fair that someone's got $500 million in super? I think was the message at the SMSF conference in February 2023, which then led to this sort of being them announcing this. So we're just really not necessarily going to see that. But it is where we will see it is where people are taking that risk. And you need those risk takers in order for some of these unicorns and amazing, investments to come through. So I don't know. It's one of those things. Time will tell the impact that has on all that sort
Well,
of stuff. And once again, we sort of digress a bit.
but it just goes back to this. This is a revenue grab. I mean, you can't justify it any other way. If we put forward so many good arguments to say that, look, we might not be able to get it scrapped, but do it in a more
A different
sensible
way. Yep.
fashion, um, they're not going to have it because it's going to leave too much of a fiscal hole in their budget and their forward estimates. So they're not going to go for it. But to take that a little bit further. Uh, I'd imagine it would discourage investment from SMSS in any sort of volatile asset. And I
Yeah,
know
that's right.
uh, crypto probably falls under that banner because, and there's no raw statistics to really confirm this, but speculation suggests that perhaps um, the lowering of the demographic who are making up a large proportion now of the establishments is for the flexibility of investing in things like crypto
Crypto. Yeah.
in their super fund. There's no actual data-based factual element to that, but there is speculation that that could be one of the things that is driving
One of the
that.
drivers. Absolutely.
Well,
Yep.
if that is one of the drivers, then gosh, it's probably, unless there's some better sort of stability in that asset class, and it may well be obviously in the future, but right now it is still pretty volatile as far as its valuations go. Um, is that going to stifle that whole thought process? Is that going to stifle um, further investment in cryptocurrency? And no matter what you might think of the asset class, it's still a legitimate asset class. And if people want to invest in it,
It's
they
up to
shouldn't be.
them. That's
Yeah, that's
100%.
right.
Yep.
They shouldn't be restricted from doing so, or the benefit of doing so be sort of penalized just because the asset values fluctuate a little bit and you've timed it badly and you've
Yep.
come out, you know, in the worst possible way as far as that
But
goes.
from that perspective, so a lot of younger people, you're right, are setting up new SMSS. They're not going to be even remotely close to this 3 million for
No,
a period of
no.
time, unless they go in and in a crypto or in a volatile asset and it goes up. But then from that perspective, then they've made lots of money. Well, on paper. So that's the other thing. The volatility, if you end up and then like that's there's no gradual sort of way that can be moderated. So that's one of the considerations. So I mean, what I don't want people to do is think, oh well, I won't put extra money into super for my retirement because I'm going to be hit with this extra tax at the back end. And they're thinking about that now. So they're thinking about that in their 40s and their 30s. And I mean, it's a long bow to draw in your 30s to be thinking about your retirement in 25 to 30 years' time. But once you get to your 40s, that it's on your thinking from that perspective. I don't want this to lead to people going, oh, well, super, like not thinking of super as in the right way. So that certainly is a consideration. But anyway, I'm going to move on with some of my other myths just quickly before we
Okay.
touch on a
Yeah,
couple of
good, good,
strategies.
good, good, good.
So in line with that, I'm paying 15% tax. One of the areas with that was if I'm over 3 million, So I used my example before. I ended at 4 million and I've got my $3 million threshold. The amount above 3 million is taxed at 15%. So if I was $1 million over, I'd be paying 150 grand in this tax.
Yeah.
As we've already gone through, it's an increment of that. And it's not about, so your the total super balance, your closing total super balance, I'll get there, that determines the proportion that you're in excess of the 3 million. And therefore, then you've got to figure out what your earnings are. So I could end on 4 million, but my earnings over the year is 100 grand or $1.50, like it's nothing, or I've gone backwards. So it's not, oh, well, I'm over 3 million and I'm at 4 million, that's taxed at 15%. So that's another one I get. And then the headline of a lot of this, just in terms of the rate, was looking at, so that, super has the tax concession of 15%. And so, everyone's aware of how that sort of works. And a lot of the, when you read like the PR on this, is reducing the tax concessions from 15% to 30% tax. So I said it's a reduction of the concessions, but you know what I mean. No one's ever going to pay 30% tax. The guy I mentioned earlier with 1.5 billion, his effective tax rate on these earnings was 14.97%. From that perspective. And then you've got in the fund itself, if you've got unrealized gains in that fund, you're not paying 15% tax in the fund on any of those. It's only when you realize them that you pay tax. So potentially in the year that you sell an asset, that might have a higher incidence because you're paying tax on the realization and then a bit here, but only if over that year that's where that whole gain has been earned. So the 30% tax is again a bit of a furphy. And then the better off investing outside. Most of the numbers I've run on that is that is the answer to that. You're not better off investing outside, but certain assets will lend themselves to having a look at that. And then I want to touch on this, a couple of other things. One is asset valuations. So with people are talking about, and I appreciate that when this podcast is released, it'll be after 30 June. So a lot of people were talking about, I've got to have the highest valuation I possibly can at 1 July 25. Now, there's not a lot of leeway for valuations really out there these days. Property, you get an independent valuation. Maybe you can maneuver that within the range that's required within reason, or the range that's provided rather. But any other asset, if you've got listed shares, that it is what it is. If you've got unlisted, widely held units in a unit trust, then the unit trust administrator or trustee, they will give you that closing balance. If you've got unlisted shares, if they're widely held, again, you'll generally get a valuation provided by the product or by the administrator or the trustee or the directors of that entity. So it's property valuations within a small range, and then potentially some closely held private companies if there's an opportunity for a valuation to be undertaken. Now, they are expensive. So it's to value an active business, it is a very expensive undertaking. So that valuation side of things, when it comes to unlisted companies and unlisted unit trusts, that there might be some leeway there where the underlying asset in that entity is an active business rather than it being something that's backed by property or some other assets out there. So if you can, so the asset valuation side of things, if the asset truly has gone up in value and an independent valuer will tell you that is a great starting point for the future, things moving up in value. And hopefully that asset stagnates a bit over time. And then when you sell it, that's when you might get the big uptick. But we're crystal ball gazing at its best here from that perspective. So it is worthwhile looking at that. The other thing that So a high valuation will help in what those ongoing earnings figures might look like. But a high valuation will also lead to a higher total super balance, which means that the extent to which you're in excess might also then be reasonably high, and maybe not on that particular asset because it doesn't really generate much income or whatever, but on your other assets that'll come through. So yeah, anyway, just a few more ranty things to dispel and have a chat
No,
about.
it's an interesting point because this already has been covered in the consumer press. I've seen articles about this already and they're probably specifically referring to property and direct property um, in this case, but the there is already a thought process of how can I manipulate the valuation, as in how can I get a lower valuation if I'm not up to the $3 million threshold,
Yeah,
so
yeah.
that I can escape being caught by that net. At the other end, I've conceded that I'm going to be caught by the net. How can I get a higher valuation to make sure that the difference between opening and closing is minimal, so
It's
that
minimal. Yeah, that's
so I'm
right.
not up for the same thing. And I suppose, you know, you're not going to be able to manipulate that really if you go to a reputable expert valuer on these
Well,
things.
if it's for it to be truly independent and you know the valuers, so the property valuers as an example, they've got their own code of conduct, and you know to be a licensed valuer, you can't just go off piste
No,
from that perspective either.
no,
So then the
but
other thing with those people that are, oh, I want a lower value, so I'm not triggered in here. Again, if you end up being you want to be at 2.9, but you end up at 3 million and $50,000 on 3 million and 50 as a percentage is 4/5 of 5/8 of bugger all. And then depending on what your earnings is above the 3 million, so if you started the year at 3.3 million and 25,000, and then you go up to 3 million and 50,000, then you're talking $25,000 of raw earnings taxed at hardly anything. So the just the incremental side of it all is I understand a lot of people don't want to pay tax on their unrealized gains. Absolutely. But when you run the numbers and look at the increments, there's a lot of the time, or not a lot of they can be insubstantial amounts in the context of any other structure that you might have held that asset.
yeah, I think you've always obviously got to apply some concept of relativity here as
Yeah.
to exactly how damaging the liability is going to be. The only problem and on that valuation issue that's being raised is that the industry doesn't want to open the door for dodgy valuers
No,
come in to
100%.
do
Yeah.
that because there are always going to be people who would like to take advantage of doing this and saying, "Oh, Gemma, what do you want it to be?" Like
Yeah.
I can make it what you want it to be. So you tell me what you want it to be, and we'll go about doing that. Now, I'm not for a minute suggesting that they would pass any sort of ethics test or whatever, but we know there's people out there. I mean, there's tax agents out there who do that. There's auditors out there who do that. Um, so, I mean, that's probably another concerning thing is that, well, don't tell me it's going to open the door for something like this happening. And of course,
It
then
could do. It
and
could.
and of
The
course, then
auditors
that leads.
though, sorry, you go.
Oh, well, I was just going to say that then that leads to, we hear numerous stories about how regulators don't have enough resources to commit to whatever they have to monitor now. That's another thing potentially
Another
that, all
thing.
right, so now we're going to have to look at these guys. Can you have a look? This bloke seems to be doing a lot of sort of fluctuating valuations. Have a look at what he's doing, Is he on the up and up or whatever? Is that really another thing that we want the regulators to have to do? because they're going to have
So
to.
the regulator is like the tax office is already sort of pushing back to auditors on valuations, and then now that auditors have to be registered with ASIC, so the integrity of that, like independence, all those sorts of things, that's sort of increasing. Then because of those recent cases, the auditors they're far more particular about what they need to see in order to sign off and not qualify an audit report on evaluation. And there was a whole bunch of letters that the tax office sent out to auditors where the valuation of the direct property in particular funds hadn't fluctuated from like annual return across annual return. So I think that there was already some integrity measures sort of happening there. And but again, that doesn't save all of us from that perspective. And whenever there's an opportunity to, there's those opportunistic people out there that might then charge a big fee in order to then, manipulate those valuations or those values. And that's unfortunately, that's life. I'm not saying that it's okay, because absolutely is not okay. But if people are really that concerned about it, I'm just maybe I'm like, good luck to them if that's really what they want to be doing to save an incrementally small potentially amount of tax at manipulating those valuations from that perspective. So
But I mean,
I've
it is
become a
concerning.
skeptic, haven't I?
No,
Oh, it's
but it
awful.
is concerning, Gemma, because how often do you hear the 3-year valuation rule put up
Yep.
right now, and that in itself is a myth. So if you are building upon that sort of misconception, it could make the situation worse. I hope not, but we all know that there's bad actors out there who
Yep.
this is the perfect opportunity for them to seize on something like
Them to
this.
get the Academy Award.
Exactly. So
Yeah.
yeah, it's
Yeah.
it's a bad situation all around. But let's let's
So
discuss how
I
people
just
can
a
use
couple
the
of other
force to
one
strategize.
last myth, which isn't
Oh,
really a
okay.
myth, and this is a big concern, is the cash flow position for a lot of funds, because uh, particularly the funds that have the farmers. I'm just going to really just throw the farmers in there. It's a very lumpy asset, illiquid. Values have gone like escalated unbelievably, and without the cash flow flowing out. And then you might have multi generations in a single fund, and you've got the grandparents drawing out pensions, and that's enough cash flow to cover that. But now all of a sudden, if this from a cash flow perspective, now back to our original points, this is a tax that can be paid by the individual. It doesn't have to be paid by the fund, but there's still that cash flow element. Now, what I'm kind of hoping only for this purpose is that because we've had this run on these values, that maybe they'll stagnate a bit now, so the increments won't be too bad. But we just don't know. It just depends on what those properties look like. So that is a real concern. But like for now, so where we are early, when this is released in the 25-26 year, the first assessments for this won't come out until the absolute earliest of November 2026 for the 25-26 year. Absolute earliest. Mostly the SMSFs, like they'll have a lodgement due date of May 2027. So are some people going to kick out that and lodge at that time so that this assessment doesn't come through? I suspect that some people will do that, but others, so I reckon there'll be a real challenge for some people who want to get the tax refund in their SMSF because of franking credits, but won't want to lodge early because then the Div 296 liability will kick itself out. Anyway, so that's going to be interesting to see. So at least we've got a couple of years for those that might have cash flow considerations to plan. So I would encourage people that if they've got clients in that realm, that maybe you do if you haven't already done a calc of 23, 24, as if it was 25, 26, and obviously when 25 has finished, undertaking another calc saying, okay, right, Darin, this is how it's going to impact. The liability is 100 grand for one member, or 100 grand total between all the members. How are we going to fund that? We fund it from outside. How do we do that? We fund it from inside. How's that all going to work? That is the one of the big ticket considerations.
Yeah, 100%. And of course, one other area it might impact, and it's a popular strategy, of course, is to have business real property in your fund.
Yep,
That's the same
100%.
sort of
Yep.
principle on that. So very concerning. But look, as we near the end of it, you
Of our time.
You
I keep
interrupted my
interrupting you.
Star Wars
I know.
reference to
Well,
say
before
that
we do
let's
that,
use the force and find out what strategies people can
yeah,
implement
yeah,
to deal with
exactly.
things.
Do or do not. There is no try. Okay, so
Exactly.
some strategies here to have a look at, and you sort of like the example we gave earlier of someone's got 5 million, someone's got 1 million. Is there an opportunity for us to try and equalize that? So do we pull out? This is on the basis that A, you can contribute the money back in. So if they're over 75, you're stuck. And that the person can take the money out. So this prime 65 to 75 sort of realm there, we take out an amount and contribute it in as a non-concessional contribution. So that's just going to reduce the amount down here. It also free, if this person's got 1 million, they likely haven't fully used their transfer balance cap. So there's an opportunity there to add some more money into pension phase. So that's one option. The other one you've alluded to earlier is, do you pull money out of super and put it towards the family home? Now, that family home could be mum and dad's family home, or is this an opportunity for mum and dad to pull some money out of super and perhaps gift or lend it to their kids to pay down mortgages?
Yeah.
So that's a big one that we're chatting to our clients about, an opportunity for a pre-inheritance there. So now, do you treat it as a gift or a loan? That's got its whole other element from an asset protection perspective. That is another hour of discussion. So that's one thing that we're looking at. The other one is a similar vein, and maybe it's because I'm mean. I'm like, right, Bob, you can take out an amount to give to your kids, but let's get them to put it back into super. So they might have paid off their mortgage because the bank of mum and dad has already helped them out there. So why don't we pull down some money out of super? You gift it to your kids and then they throw it back into super. They're in their 40s. It's a great way to really kickstart that trajectory for them for their retirement. We've gone from a 15% environment, because invariably we're pulling this out of mum or dad's accumulation account, and then it's going back into a 15% environment. So we're helping with Div 296 exposure, some early inheritance benefiting the kids, and the parents get to see the benefit of that. We're looking at some death benefits tax benefits of doing that as well. And we're just changing, we're going from a 15% environment to another 15% environment. So it's ticking some boxes from that perspective. Again, am I being mean by it just going into the kids' super rather than paying off their mortgage? Probably. But also, if they've already paid off their mortgage, or mum and dad have already assisted from that perspective, and these are the sorts of people that we're talking to be honest, the kids are already fine, and mum and dad, they're not going to spend this money. They're north of 75. They're not, it's money that they're not going to spend over their lifetime. They want to see their children benefit from some of this money without having to pay a bit of tax there. So it's one of the benefits of 296 has brought forward a lot of estate planning discussions. So
Yeah.
I'll have to, give it some credit there. Not much though. So yeah, those are the sorts of strategies that we're looking at. One of the other things that people still ask is, why should I put more money in as a contribution if I'm going to be hit with this tax? So the first thing is, usually when you're in this realm, the only contribution you're making is a concessional, maybe a downsizer, maybe a small business concession, because you're not subject to total super balance thresholds with those. So your concessional contribution, it's 30 grand. You possibly, the reason why you're making it is for other tax reasons on your personal side. So the downside of making it is pretty minor, and super is still the best entity for these sorts of things, because you're still going to get the benefit of that invested at the super fund level at those better tax rates. So just to bear that in mind as well.
Yeah, really good point. And I'm sure people who will benefit from those actions will be thinking along Homer's lines,
Yeah.
strategies.
Yeah.
I got I got it in. I
You
got
got
it
it
in.
in. You got it
I got
in.
both
Yeah,
in
yeah, yeah.
today.
Yeah.
So I think we're just about out of time now, Gemma.
I was
Um,
going to use my Homer reference when I said, 80% of the people, and I will use it now, 80% of the people who are going to be impacted by this in retirement age. Now, that's a stat that I did see. And there was an episode of The Simpsons where Homer said, um, did you know that 84% of statistics are made up? 46% of people know that. So there you go. That's going to be my ending point of today.
No, that's good. That's good. It's been a good discussion. I could have spoken about this for the next 3 hours, pretty
I
much.
know, same. Yeah.
There are so many issues that I haven't touched on that are causing concern, and no doubt they'll be raised within the immediate future
Yeah.
as this comes a little bit more to fruition and we get a better picture on exactly how this is going to work. But look, we've addressed some of the issues. I think we've busted some of the myths, which is really important as
Mm.
far as knowing what to do from here on in. So hopefully anybody who's listening out there or viewing this on YouTube, hopefully you've got something out of it and you've got a slightly better understanding of potentially how it works and what you can and maybe should do in reaction to it. So other than that, I'd just like to again thank Jemma Sanderson for being with me for this podcast. It was really good, really enlightening, and a really good discussion.
Yeah. Thanks once again for having me.
Thanks again to my production team who is putting this together and obviously posts it to all of the channels that it goes out to. Don't forget, if you're enjoying this content on YouTube, please hit the like button and subscribe to the channel. Other than that, thank you for your company. Again, we hope you've enjoyed it as much as we enjoyed bringing it to you. And we hope you'll join us again when we do the next episode of the Cross Country Super Podcasts. Travel safely and bye for now.